Well, I am John, and Deanna will be here tomorrow. You will know the difference between us. Yes, one, I'm taller. Secondly, she is the one with the accent. So, but she will be here. I talked to her yesterday afternoon, saw her in the meeting in Grand Junction. She had come in before I left. And it was just a great opportunity because Deanna and I, when she was full-time, we were always opposite one another. We would do the flip-flops. And so we had quite a great working relationship all of those years. Well, we have a lot of material we're going to cover. This has been, unfortunately, last year, an interesting year for us. It was a very difficult year for us. The delays in getting the famous 31 tax forms, not knowing literally until the second day of January what the tax law was going to be, having to wait for the IRS to implement its computer programs, all of it was extremely stressful. And it appears that we're going to have a smaller version of that this year. The IRS has announced that the earliest possible, unless they've modified it since I read the announcement, the earliest possible day for us to do electronic filing this year is the 28th of January. And it could be as late as February the 5th or the 9th. I get those numbers confused. But even with that, that's a month that we have lost. And they blame it, of course, on the close down of the government. That because it was closed those days, that delayed them 30 days. So we will see what will happen. We're going to do the latter part of the book, and if you'll turn into chapter 11. Now, I always like chapter 11. I don't care what the topic is. In fact, I've probably taught the wrong topic before. I did that once. I hope I never sound like it in a seminar, but for over 20 years I was a college professor. And I remember I had all my notes, lecture notes in books like these, and I was running to a class and I grabbed a book, got to the class, opened it up, and it was the wrong set of lecture notes. That didn't stop me. I taught what I had. They didn't know the difference. But I like chapter 11 because I get to tell one of my stories. I don't know any jokes, but mine are true life stories. My wife, for many years, taught on a military base. And in that time, she had one and only one student teacher. She said, "I'll never have another one." She taught 6th grade, and the student teacher was going to teach social studies, and got up and began by telling the students that today they were going to begin their studies of World War XI. Somewhere in my history, I lost 3 through 10. I related that story to a friend of mine who supervises student teachers, and he said, "I can top that." He said, "I actually heard a student teacher tell their class that the primary cause of the First World War was the assassination of the Archduke Ferdinand." Not a kid asked what an archduke was, he said. And I said, because they know. They watch those wonderful Aflac commercials. Well, on the 2nd of January, the president signed into law a bill with an amazing title, the American Taxpayers Relief Act of 2012. That's a stirring title. It makes us think that we got relief. And we did. They relieved us of more money from our checking accounts and our wallets. What Congress actually did was very little except for patch. They ended up doing 3 or 4 things. One, they extended many provisions for 2 years only, 2012 and 2013. As a result of that, at the end of this year, the end of this month, 51 provisions of the tax code will expire. And the best way to track these is, and this is a wonderful source of quick information for you, is go to the internet and go to the website for the Joint Committee on Taxation. And you can print the same thing off free that many of the publishers will sell you when the bill immediately comes out. They'll give you the Joint Committee report. It's the very same thing because it can't be copywritten, being a government document. But you go to that and you'll get your list that goes well beyond. In fact, I believe the last one they have on there expires in 2021. But we do have 51 that will expire. In addition to those that were extended for 2 years, they extended others for 5 years. And so these will go through 2017. Then they made some provisions permanent, some with adjustments, some without adjustments. And as a result of this, we ended up with almost the very same thing that we had before. We simply had to wait for it. One of the interesting things they did, however, that is permanent, is they introduced or reintroduced the old 39.6% rate. And if you'll turn, please, to page 11-2, let me show you what they did with the rates. These were rates against the higher income. In fact, there is a threshold. If one is married and you're filing a joint return, your threshold amount is $450,000. If you're single, it is $400,000. But I want you to look at the table. First of all, there are 2 corrections in mine, and I don't know whether they've corrected them in yours or not, but if you will look on page 11-4, look in the second column of numbers, the third number down, that should read $87,850. On page 11-4, third column, third number down, second column, $87,850. And in the first column under single, one number up from the bottom, it should read $398,501. Now, here is the problem. They were trying to bring back the 39.6, but to preserve the brackets for those in lower levels. And on the single filing status, look at the rate bracket for 35%. $1,649. That's how narrow that 35% bracket is, so they could get in the 39.6. And then if you are married, it's a little better, but it's only $51,649. The other thing I want you to see in the table is go to the very bottom of the page to the estates and trust. There you see the highest rate, 39.6, hits at $11,951 of income. Keep that in your mind, because you're going to see a little bit later this morning, before the break, the terrific impact that this will have on many estates and trusts this year. Yes?
Did you see under the estates, the second column, that it goes from 2150 and then it jumps to 2451? And then the next one's 5,000 and it goes to 5701?
Yes, and that is incorrect. It should go to, it should be to 2150 to 5700. Thank you.
Same problem with the next line.
Yep, the same problem. They didn't proof it for some reason. Now, when you get into 39.6, they did something else. Flip back one page to page 11-2. See, this is how I keep you from taking a nap. And if it gets too warm in the room, we flip even more. That gives us the breeze that cools everyone off. Once you hit the 39.6, you're out of the famous 15% bracket for dividends and capital gains. You're now moved into the 20% bracket. So you have a higher capital gains, you have a higher dividend rate of tax. Now they did a couple of other things, and none of these are new. They have been in the code before. They have been brought back and forth over the years, but if you'll turn please to page 11.5. The second thing they did was the phase out, to bring back the phase out of personal exemptions. Here, once again, there is a threshold, but it is only $300,000 if you are married filing jointly and $250,000 if you are single. And once your AGI gets above that threshold, you will lose 2% of your personal exemptions for every $2,500 or part thereof that you're in excess of the threshold. So literally at $300,001, you'll lose 2%. That should tell you, go back and check your rounding before that. And make sure you have it right. But again, this is the phase out. The other thing that they did was to phase out, bring that back, itemized deductions. Our phase out of itemized deductions again falls with the very same threshold of $300,000 and $250,000. And itemized deductions are reduced as we move above those thresholds by the lesser of 3% of the excess of adjusted gross income over the threshold, or 80% of our itemized deductions. There are, however, 3 itemized deductions not subject to the phase out, and these are not listed in the text. But here they are. 1, medical. Now, what the law did with medical, which is discussed a few pages over, but I'm going to hit it now because it's very simple, they raised the amount of the reduction from 7.5% to 10% for taxpayers who have not reached the age of 65 on the last day of the tax year. This will be in place for 5 years. And at the end of the 5th year, there will be a 10% reduction for all taxpayers. But now, if you have a joint return and either spouse is age 65 on the last day of the tax year, then that will qualify the return, and the reduction in medical will only be 7.5%. Because of that built-in automatic reduction, you do not have a phase-out of medical expenses in the new phase-out rule. The second, casualty losses. You recall we have both personal and business, and for the personal casualty losses, we have a $100 floor to begin with. Then overall, it's 10% of AGI. Because that already has a limitation, casualty losses are not subject to this phase out. And the third, investment interest expense. Since investment interest expense is limited to net investment income, it already has imposed upon its deductibility a limit. Therefore, the investment interest expense is the third item that is not subject to this phase out. Top of the next page, or the bottom of page 11-5, Roman numeral 4, the alternative minimum tax. For many years, we have worried about the AMT. Every single year, we would have to find what has Congress done, because the AMT was not indexed. So the first thing they did for 2012, if you'll turn over to page 11-4, 11-4, Item D. 11.6, I'm sorry. I need to put on my glasses. If I call a page number wrong, you let me know. 3 eye surgeries this past year, so 54 years of wearing glasses, and now you don't have to wear them, and I can see 20 miles, but I can't read. You know, they give you a choice. You could have lens that see distance, lens that see close, or one of each. And frankly, with my brain, I was scared of one of each. So 11.6, I'm sorry. What they did, they brought this up to date, and that's where we got this $78,750. After 2012, these amounts are indexed automatically for the very first time. And for 2013, we have that $80,800 exemption if you're married. If you are single, it is $51,900, $40,400 married filing separately. Now, I don't believe the text addresses this issue, but these two are subject to phase out. And if you are married, the phase out begins at $153,900. If you are single, it begins at $115,400. And also, don't forget, the AMT is a 2-tiered tax. And at $179,000 of $179,500 of alternative minimum taxable income, you jump from the 26 to the 28% bracket. Now, there is another exemption that's not here. And I always have trouble finding it. I don't know what the big secret is, because I have quite a few clients that are subject to it. And it is the type of client that most likely will be hit before any other taxpayer by the AMT. And who would that be? One subject to the kiddie tax. That exemption we would normally think would be single, but it isn't. It is $7,150 plus their earned income. It can never be more than the single exemption. So this year it can never be more than the $51,900. Once it gets to the $51,900, it too will phase out if the AMT income is greater. But always look for those with the kiddie tax, because they will be hit faster than anyone. And it gives you, knowing this, it gives you a great opportunity for tax planning. I have a client family, and they're triplets in this family. This year they are 18, and their mother is having a fit over that they've now turned of legal age. The reason is their grandfather wanted them to have the lifestyle that he had enjoyed, and before they were a week old, he had transferred to each one of them $1 million in assets. Now, the children did not know what they had. I guess the mother and me and a couple of other people were all that really knew, because she would never tell them. Now, the family owned a business, and they put these three to work in that business as soon as they could get a work permit. 2 boys and a girl. And they played no favorites. It was a building supply company, and I've seen her load lumber on a truck. And they had to work. It was no fake, they just owned the payroll thing. They worked on Saturdays and during the summer. And I have to share this with you. Their mother is quite a businesswoman, and she does the payroll. And so she would, when I was talking to one of the boys not too long ago, he came by the office when his school was out, college was out, back in May, and we were talking, and he said something about, well, he had to go, he had to get to work. But he said, when we started all this, I remember when my first paycheck, my mother brought the three of us in, and she explained how we got paid. She was training them that they were making minimum wage. They worked so many hours and so on, and about the taxes being withheld. And I said, yes, and that gave you your spending money. He looked at me rather funny. He said, spending money? He said, my mother, she got that to the point where she said, this was the gross, here's what's withheld, what's left over is take-home pay, and Mama took it home with her. And that's exactly what she did. And what did she do with it? IRAs. So, there are wonderful opportunities even in these with tax planning. But the key for AMT this year, it is indexed. That's the good news. The bad news is, you'll see in a few moments, we are paying and will pay a high cost for that trade-off in another provision of the law. Page 11-7, the tax breaks for children. The child tax credit was restored to $1,000. It is, however, it was extended for only 5 years. And when I looked at that, 5 years would be 2017. How convenient. It is not an election year. So then, because this is one of those well, there won't be an election year for that. Child and dependent care credit is extended permanently. The rates are 20 to 35%. It depends on your income. The cap on the dollar amounts are $3,000 and $6,000. Earned income, 5-year extension. Again, this is a political hot potato. There's no area in the law that anyone will admit that has more fraud than the earned income credit. That is why they put the burden on us as practitioners, and we have more questions to answer. It apparently has not done a lot of good. A few weeks ago, I picked up the Saturday paper and saw that a federal judge in Charlotte, North Carolina, had sentenced 2 women because they had filed bogus tax returns and claimed and received approximately $5 million in tax refunds based on fraudulent earned income credit claims. Now, what made it so unusual to my way of thinking, the entire $5-point-something million in refunds were all mailed to the very same physical address. You would think that the IRS would have some way, but they don't apparently. And so $5 million in that. Item D, page 7, the adoption credit. I think the text has another typo. My sources tell me it is a $12,970, not $12,790. Now remember, we always call it a credit, but it's better than a credit if your client has an employer, and the employer has a benefit program where they will reimburse for expenses incurred in an adoption. Up to the $12,970 of reimbursement, that amount can be excluded from the tax return. So we have an exclusion where it is paid for by an employer, or a credit where it is paid out of pocket by the taxpayers. The major change in this year is that if the adoption was finalized by a foreign court, then the taxpayer is required to obtain a certificate of adoption, certification of that adoption, from the Department of State. That must be attached with the return. And of course, any return having an adoption exclusion or credit is not eligible currently for e-filing and must be paper filed. Now, if it is the adoption of a foreign-born child, but the adoption was finalized by a court subject to U.S. jurisdiction, that is, any U.S. court. It doesn't have to be federal, it can be state, whatever, but as long as it was finalized by a U.S. court, then you do not have to have the certification from the Department of State. It is only where it is from outside. Item F, page 11-8. The HOPE and the American Opportunity Credit. This was only extended for 5 years. So those who have kids that are coming up now in high school, if they're not a senior, this may be gone. I don't know. I hope not. I have a vested interest in it because I'm on the board of trustees of a private university in North Carolina, and I can tell you the impact that this has. But it was only extended for 5 years. Unfortunately, the tuition and fee deduction up to $4,000, you had an option of the two, that will expire on December the 31st. And that can be quite expensive to the parents or to the taxpayer claiming the deduction or claiming the credit. If you, as you well know, if you have children in school or grandchildren, it doesn't cost what it used to. And I don't know why I have this in my desk drawer. I was cleaning out the desk drawer for some reason. I think it was because I couldn't either close it or open it. You know how you'll just throw something in, make sure you know where it is? And I found, when I had gone to summer school, the tuition was $42.50. Isn't that amazing? $42.50. And no, George Washington was not president at the time. That's what one of my friends' child asked me when I mentioned that, said something about that. So watch that one. The Coverdale savings, $500 limit now. And you must make the contribution no later than December 31st of each year. Student loan interest. This is the next housing crisis. The amount of unpaid student loan debt continues to increase. So much so that one of the largest financial banking powers in the nation started declining and refusing to accept applications for student loans on November the 1st. They're out of the student loan business. It's very expensive to service these. Students are not paying the money back. There's very little incentive for them to do so unless the IRS gets the right of offset, has the right of offset with it. One of the things that has been largely criticized has been the limit on the deductibility of interest. Well, they claimed they adjusted that, but what they did was they removed the 60-month time limit. Now you may deduct up to $2,500 of student loan interest. However, if you are married and you are filing a joint return, that begins to phase out at $125,000 of AGI, and at $155,000 you don't get anything. And if you're single, it begins to phase out at $60,000, And at $75,000, nothing remains. Mortgage insurance premiums, 1 year. It was actually extended for 2, but one of those 2 was 2012. So we don't get that passed this year. Qualified principal residence indebtedness exclusion, 1 year, goes through 12/31/13. And after that, that currently is supposed to expire. Top of page 1110. The deduction, the optional deduction for state and local sales tax. That has not been extended. It had a 2-year extension for 12 and 13. And that will hit, believe it or not, it'll hit a lot of people, not just those in states that have no state income tax. In my own state, if you are a retired federal employee, state employee, or local government employee, you pay no income tax on your retirement. And the way the formula works, they don't calculate and adjust for any of the itemized deductions. Whatever your retirement is, you subtract it out. I don't have a single retired state employee that pays state income tax. So they have been relying on this deduction to lower their federal tax, and that will no longer be the case after this year. The charitable deduction on transfer from the IRA. What a mess we had last year. No one knew. Finally, it came out in the bill, and of course, the bill wasn't passed until the very end of the year, wasn't signed by the president until 2013. It was too late. So they put in a provision that if you made a contribution or direct transfer from the IRA in January of 2013 to a qualifying charity, you could deem that that was made on December the 31st. That brings a problem that you and I may encounter. If our clients are bringing in information, we see there was a transfer in January, we have to determine which year. Because I have a client that's done it every year, they've been eligible to do so, and they've always done it the first week in January. So we've got to make sure with this one that we are not counting it for the wrong year. The business deductions. We're taking a hit. If you'll turn over to page 1112, there are 2 tables there. And if you'll mark through the first table, just scratch it out, put an X through it, because it didn't happen. That's why I never like to see something like this, because it could be confusing. So strike it out. The law extended through for 2 years, 12 and 13, the $500,000 Section 179. The phase out is at $2 million, and we're still permitted up to $25,000 on an SUV. On January the 1st of 2014, it drops to $25,000. $200,000 property value acquisition phase out. We're still permitted to use the $25,000 for an SUV. Now, whether this will stay in there, no one knows. The morning paper has an article on how much longer the Fed is going to be holding up the economy with what its current practice and holding down rates. So, and apparently their economists believe it's not going to be too much longer. So we don't know what's going to happen, but I do know we got some bad news with this. You remember I told you we paid a price for getting AMT indexed? Well, the price was they have de-indexed Section 179. So now it will no longer automatically float and be recalculated. This can only be changed by Congress. Also, the bonus depreciation, 50% for 2013 expires 12/31/13. And remember, in many respects, bonus is better than Section 179. You know, and think about these things. First of all, it's if you have less than or fall below 50% business use, there's no recapture of it. Secondly, it can create an NOL. Section 179 cannot create a net operating loss. It has a limit. And although we can carry it forward to offset income in future years, what did your client rather have? Reduced tax in a future year or a refund of tax from a prior year? And they want that refund. And they get it with bonus. Also, if you have a trade-in, like-kind exchange, Section 179 can only be applied against the boot. But bonus depreciation is against the adjusted basis, which includes not only the boot, but the basis of the property traded in. So it has great and wonderful implications. But at the end of this year, it is set to expire. Turn, please, to page 1114. In 2010, in order to assist primarily the restaurant industry and convenience store industry, they created 3 classes of real estate that they made subject to Section 179 and bonus depreciation. In addition to that, any amount not taken under 179 or bonus that had to be depreciated, they had a 15-year recovery period instead of 39. These would be our qualified leasehold improvements, qualified restaurant properties, and qualified retail improvement. And for the qualified retail improvement to also qualify for bonus, it had to meet the definition of qualified leasehold. 2013 is the last year for these. And next year in 2014, no Section 179, no bonus depreciation, and we're back up to 39 years. 3 credits remain. You'll look on page 11-15. They were extended for 2 years. One is the research credit, that 20% credit. Probably most of us would not have a client subject to that. But we do have those that can take advantage of the work opportunity credit. And for 2013, originally, it was to be limited to qualifying veterans. They went back and changed that so it's not only qualified veterans, but it is also employees that were hired and eligible non-veterans as long as they begin work prior to 1/1/14. There is also a differential pay credit. This is designed for those who employ military people. It's a very significant thing where I live because we have the largest military base in the United States in terms of personnel. And in this credit, if your client has an employee who is in the reserves or the Guard, and they are called to active duty, I believe the time period is it must be more than 30 days. If your client makes up the difference in pay between the military pay and what the client was paying them, their military pay is $16,000. The client was paying them $30,000. They make up that difference of $14,000. they get a special credit equal to 20% of the first $20,000 of that differential pay. But again, this is the last year for it. We give you a complete set of tables over the next 10 pages, but turn with me and let's go to page 1131, item 3. The first really new thing for 2013. Under the Affordable Care Act, we now have an additional 0.9% Medicare tax. This is a tax on Medicare wages. So it only will apply to the W-2 and to the Railroad Retirement Act, Tax Act, and to self-employed individuals. There's a threshold, and the threshold, if one is married, is $250,000. It applies only to the combined W-2 or W-2 and self-employment income above that amount. $200,000 if you are single. The Railroad Retirement Tax Act, those who are covered under that, they will have the full benefit of the threshold. You do not add W-2 for regular purposes and Social Security purposes and the W-2 Railroad Retirement Act Medicare portion together. They are treated separately, they're calculated separately, even on the return or the form itself. If you'll turn over, please, to page 1132, it applies to all wages subject to Medicare. So if we're looking at a W-2, we're going to be working with box 5. If we are looking at self-employed, we will go to the Schedule SE in the appropriate part line in Section A or B. Now, one of the things that bothers me is item number 6 on page 1132 in the table. And it bothers me because there's a general misunderstanding where it says a reimbursement of employee business expenses under non-accountable plans. You have a client that comes to you and they tell you, I have just hired someone in my office. I've never had office staff. And part of their duties will be to go to the bank every day with the deposit and to pick up the mail. And I'm going to reimburse them the federal mileage. You noted that that fell 0.5 cent. And that's all they tell you. Now, the question that I have for you is, from the information I gave you, is that reimbursement taxable income to the recipient? And the answer is, yes, it is fully taxable on the information that I gave you. Here's the misunderstanding. Just because it is a federal amount, the mileage or the per diem does not make it non-taxable. The sole purpose of these set amounts established by the Treasury is that it's deemed spent. You do not have to show you incurred any out-of-pocket expenses. It's deemed if you drove a mile, you spent 56 cents? It's deemed you spent that. What makes it non-taxable is one little piece of paper called an accountable plan. And every client you have that makes a reimbursement needs an accountable plan. This is not new. It came into law in June of 1993. So it's been in there for 20 years. And all that plan says is, you're put to John Smith, you will be expected in your duties to go to the post office and to run errands using your personal vehicle. You will keep the mileage and turn it in, and you tell them how it has to be at least quarterly, but turn it in monthly. We will reimburse you at the federal standard mileage rate, period. That's it. Same thing if you have clients, employees driving vehicles. You want to use the $1.50 commuting rule for non-officer shareholders. You've got to have it written in the accountable plan. You've got to notify them the method you're using. So simple, and it will save so much time and trouble. So don't let that one slip away. Taxable fringe benefits are subject to this tax, as well as awards, prizes, anything. The one thing that is not are insurance premiums paid on behalf of the famous 2% shareholder in an S, because they are exempt, that reimbursement or that payment, direct payment for it, we have to deduct it as compensation, not as health insurance, because of the S Act of 1982 and the related Rev ruling since then. So it's deducted as compensation, box 1, but it is not subject to any payroll taxes. Go down to item F, page 33. In 2013, employers were required to withhold the 9/10 tax. The 941s were adjusted at the beginning of the year for this. The triggering element or level, whether you are married or single, is $200,000. So at $200,000, we are required to withhold. And the withholding must begin in the first pay period in which the employee goes over the $200,000. Now we tell you on the next page that even if there is no withholding, the employer fails to do it, more than likely the employer will not ever have to pay the tax, although they may have to pay the penalty and interest for failure to withhold. But the IRS has slipped in something recently, and it supports that theory unless they cannot collect it from the employee. But it is a tax against the employee, not the employer. And again, it makes no difference whether or not the taxpayer is married or single, because there are different thresholds for being subject to the tax. The threshold for the withholding is $200,000. And all of this, of course, is reported on the 941. Now, our complication is the W-2, because on the W-2, this amount is commingled with all of the Medicare taxes in box 6. You don't know how much of it is the additional Medicare tax. Therefore, we will have a reconciliation of that beginning this year with the new form 8959. And we'll look at that form momentarily. Bottom of page 1135, item M. These are your troublesome areas. you have a taxpayer with more than one job. Secondly, you have married couples where both of the spouses work. Third, you have a taxpayer who may work, but their return also includes self-employed income. Now, with respect to the withholding, it's determined on an individual basis. You might have clients where both the husband and wife work in the business. One makes $150, one makes $175. Clearly, they're subject to the tax, but they're not above the $200,000. You cannot withhold. There is no voluntary withholding of this. It cannot be done. So our only option then is to adjust the federal withholding, because this tax is subject to the underpayment penalty. Now, we give you several examples, and then we take the examples and we put them on the form. So you and I are going to look at it on the form. That's the easier place, and you'll see what they're doing. Please turn to page 1140. Page 1140. Here we have Jeff. Jeff has two employers during the year. One he makes $175, one he makes $150. He is not over the threshold with either one of them. Therefore, neither can withhold. We go to the 8959 Part 1. We combine his wages from Box 5, Medicare wages. They're $325,000. He is single. His threshold is $200. $325 less the $200 is $125,000 that appears in box or on line 6. 0.9% is $1,125. He has no self-employment, no Railroad Retirement Tax Act income. Part 4, which accumulates the tax, is $1,125. We go to Part 5, which is the reconciliation. We bring down the amount of the wage. This is the only one from which they can be withholding. So we bring down the amount of the wage, which is $325,000. We add together the amounts in Box 6. And that of those two amounts are $4,713. With the 325, we multiply that by 1.45%, and we get 4713. It should be zero. He's not above the threshold. There is no withholding credit. Turn one page. On page 2 of the 1040. Line 60, we check the box that says this comes from Form 8959. We enter the $1,125. We do not have any withholding. Had we had withholding, we would add it to the federal withholding on line 62. None of it is separately stated. Now on line 62, we have not only our federal withholding, but we also have our 1099 federal withholding. And had we had excess, or had we had the withholding on the 9/10, we would have that. So you and I are going to have to redo our work papers this year to track all of these to make sure that we are accounting for them. Look at the example on page 1145. Here is John. 1143, I'm sorry. I'm going to put on the glasses. 1143. John is married. He has $245,000 of income. And if you were to take the time to calculate the tax in box 6, you would see that it's 1.45% of $245,000 plus 0.9% on $45,000. Now he is married, and that threshold is $250,000. But we're told that his wife has no earned income. Please turn the page to the 8959. Part 1. We enter his wage of $245,000. The threshold is $250,000 when one is married. Therefore, he is not subject to the tax. And on line number 6, it is 0, and line 7, it is 0. No tax liability. Part 5 is 0. But now move down in part 4, 0. Now move into part 5. We add together the withheld tax. And that amount from box 6 is $3,958. We pull that amount out. We now have his wage of $245,000 subject to Medicare. 0.9% of that is $3,553. The amount withheld is $405, and he's not subject to the tax. Now we go over to the page 2 of the 1040. We still go to line 60 and mark that it's coming from the form 8959, and we put a 0. And on line 62, we increase the amount of the withholding, which had been $24,500. We increase it by $405. There's $24,904. That's how they get it back. It's either treated as additional paid in, and if they owe tax, it would offset what they owe. If they're getting a refund, it would increase the amount of their refund, or it could create a refund. It doesn't change the basic premise, however, that John Smith made a loan to the government of $405, for which he received no interest. And that's why I can't imagine why they couldn't have the two thresholds. It makes no sense.